Hey, what's up, guys? This is Harvey. I'm the managing principal at H23 Capital. Today, I'm going to talk to you guys about how to achieve passive income through multifamily investing and how to achieve an infinite return. That's just what I like to call it whenever you are out of the deal. And I'll explain to you guys in a second. So, don't get overwhelmed by all of these numbers. Okay, I'm going to explain to you guys every single number in just a second, but don't get overwhelmed. Just ignore this for a second. Let's go over this little graph here, okay, on your right hand side. So this is how you achieve cash flow. I want to make sure everybody understands how you get to cash flow, okay? You take the full income of the property, the whole income of the property. It could be rental income, it could be rental from if you charge extra for parking, if you have laundry, right? If you have a laundry room and you're charging for that service, that's income. So any income that the property produces, you put it in this bucket, okay? Now you take all the expenses from the property, okay? All the expenses that you can think of go into this bucket. Keep in mind though, do not include the loan into this bucket, okay? That's completely separate. So you take the income minus the expenses, and what you're left with is the NOI, the net operating income, okay? That's a very important number. That number is what the actually bank uses to evaluate properties, okay? So if you're gonna take anything away from this presentation, this number is the number one number that the banks look at to determine the value of the actual asset itself, okay? So very important. So income minus expenses equals NOI minus debt, then that's how you arrive at cash flow, okay? This is the number everybody wants to achieve, either syndicators, if they're raising money from private investors, or if you're buying a multifamily asset by yourself, okay? This is the name of the game. If you can achieve this from day one, then you're doing a good job, okay? But I want everybody to understand, income minus expenses equals NOI minus debt equals cash flow. Good? Okay, perfect. Let's move on to the next one, okay? So there's a 267 unit case study. It's a real deal, and these are real numbers. But we're gonna go over every single column step by step. So we're gonna start with this column first. So back in 2005, we bought this building for $19 million. And the reason why we did that is because we showed this property to the bank, and the bank said, you know what? Based on the NOI, I think we can give you guys a $15 million loan, which we're like, great, that's awesome. So that meant that we needed to come up with $4 million of equity. Obviously, I didn't have the money myself in my bank account, right? So I needed to raise money from investors, which is what we did. So we ended up raising money, $4 million from investors, and we were able to acquire this property. Now, in a second, I'm gonna talk to you guys how important this number is, which I already did before, but actually having a plan on how to increase this income, as you guys can see on the next slide, on the next column here, it's very important, and you guys will understand in a second. But anyway, so we bought this building. The yearly loan payment now for a $15 million loan is $400,000, okay? That's perfect, that's fine. But what ended up happening was that we were able to get $300,000 of cash flow, which was tax-free, and I'll explain that in a second, because if you subtract these two numbers right here, that's where you left off, right? That was our cash flow. Now, the reason why we were able to get these $300,000 tax-free was because we used depreciation. So we took the purchase price minus the land value, divided by 27.5 years, we were able to get a $500,000 depreciation number, okay? Which is 27.5 years, that's what the IRS tells us to do. So we have to obviously follow the IRS guidelines, right? So at this point in year one, we're basically reporting to the IRS at the end of year one a $200,000 loss. All the investors that participate in the $4 million equity, they're reporting $200,000 loss on their K1s, which is a tax form that they use at the end of the year to report to the IRS whether they make some gains on an investment or if they have some losses. In this case, we're reporting losses, and therefore this is tax-free. We'll get to this in a second. Don't get overwhelmed, I'll explain this in a second. But let's fast forward to 2009. Remember how I told you guys before that we were able to increase this $700,000 to $1 million? The reason why we were able to do that is because even before we bought the building, we had a plan to increase this number. And this is the number one thing you should take away from this video as well. This number, before we bought the property, we knew we were able to increase it by adding washer and dryers to every single unit, because every single unit had a washer and dryer hookup, but they did not have actual washer and dryers inside of those units. So we were able to buy those for the 267 units, and therefore we were able to increase the rents. And not only that, but we were able to improve the landscape and also add a fence to the property. So we were able to add value to the property and therefore increase the rents, and therefore our NOI went up to $1 million. Okay. So now fast forward to 2009, we have a higher NOI, right? And we go back to the bank and we say, hey bank, how much do you think the property is worth now? And he says, you know what? I think it's worth $25 million. And we said, okay, well, how much loan would you give us? And they say, you know what? We can give you $20 million. And we're like, great. So at that point, we grab a new loan of $20 million. We pay off the existing $50 million loan that we had back in 2005. And then we have $5 million left, right? So with that $5 million left, we pay back our investors their $4 million of equity, and we have $1 million left, right? So we give that back to the investors tax-free, which is the name of the game, okay? This is what we call the velocity of money. How fast can you return the money to your investors, their equity, okay? So now they can use this money and this $1 million to invest in other deals. If they can choose to invest with you on the second, third deal, then that's the name of the game too. But that's one of the main reasons why we do that, right? Do this. We have to have a plan to return this money back to the investors as soon as we can. So anyway, so now we have $1 million of NOI. Now our equity is $5 million because that's the difference between the loan and the actual value of the property, right? So now we have a yearly payment of $600,000 because we have more of a loan, correct? And now our NOI our cash flow increases to $400,000, which is tax-free again because of depreciation. Since depreciation stays the same for 27.5 years, now we're reporting only to the IRS $100,000 loss. Okay, after 4 years, we're reporting a loss of $100,000. Okay, on our K1s at the end of the year. So now let's recap, okay? At this point in time, we are infinite in the deal. Not only did the investors got their money back of $4 million, they also got extra $1 million extra tax-free, and they're being cash flowing on a yearly basis between $300,000 to $400,000 in a 4-year period. See, that's the name of the game. You want to stay in multifamily for the long term because of the tax benefits and the yearly cash flow you can achieve, not only for yourself, but for your investors if you have some. So this is what I was talking to you guys about earlier. Now everybody in the deal is infinite. They do not own any equity in the deal. They're just collecting cash flow tax-free at this point, which is the name of the game, okay? So now let's fast forward to 2014 because we did this again, okay? Now in 2014, we got a little bit lucky, I'm not gonna lie. They say, someone very smart said one time, they say, it's not about timing the market, it's about time in the market. So if you're able to be in the market for a long time, you're gonna do well, and you can do very, very well, as you can see in this example. So we were able to increase the NOI to $1.4 million, but like I said, we got lucky because the cap rates decreased significantly. Everybody knows, right? If the cap rates go low, the property value goes up. If the cap rates go up, the property value goes down. So in this case, the cap rates went down, and therefore, whenever we went back to the bank and we say, how much money do you think you can lend us on this property? How much you think it's worth? They said it's worth $35 million, and we can give you a $25 million loan, okay? So at that point, we don't own any equity, right? So what ended up happening is we got a $25 million loan, we pay off the existing loan that we got back in 2009, and we're left with $5 million. With that $5 million, we ended up giving that to our investors tax-free, okay? So let's recap for a second. The investors back in 2009, they got their $4 million back. They got $9 million back in 2009. 2014, they got an extra $5 million tax-free because of our second cash out refi. And now they're being infinite since 2009 in the deal, just because we were able to increase the NOI, right? So now we have a $10 million equity, which is the difference between the value and the loan, right? So we have $10 million in the equity, And now we're looking at 800,000 for the yearly payments because we have more of a loan. And if you subtract these two numbers, that equals to $600,000 of yearly cash flow, okay? So after 9 years, we're looking at a positive cash flow of $100,000 after 9 years. After 9 years, we are going to report to the IRS in 2014 a $100,000 gain. So we're only going to pay $100,000. We're only gonna pay taxes on $100,000. Okay. After 9 years of collecting 5, 6, plus 4, all of this money that we'll be collecting plus all the cash flow between $300,000 to $600,000 tax free. We're only gonna report $100,000 for the IRS to taxes on $100,000. And that's the reason why we invest in multifamily for the long term. Okay, so just to recap in general, 2 cash out refis, $6 million in value add equity, tax free, and on top of that, they're making all of this in yearly cash flow, tax free as well. Only $100,000 taxed. Okay, this is the reason why I invest in multifamily for the long term, because of depreciation and also because all of the other advantages that come with having multifamily assets under your portfolio. So I appreciate everybody watching this video. If you find some value in this video, please like the video. If you guys want to leave some comments, I would appreciate those too. But yeah, I appreciate you guys, and I'll see you guys in the next one.
You nail it, man.